Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. As many of our listeners know, I lead the Techstars Web3 Accelerator, investing in entrepreneurs building in Web3 and enabling the next wave of growth in the decentralized internet and in tokenized economies. Applications are now open for our spring 2025 class, so check out techstars.com/accelerator/web3 to apply. Linda Jeng is a trailblazing leader in the digital economy and the founder and CEO of Digital Self Labs, through shaping a self-empowered future through blockchain and AI technologies. Digital Self Labs is a regulatory and policy advisory firm combining blockchain expertise with policy and regulatory strategy. With over 15 years of government experience, Linda had held key roles at institutions like the U.S. Federal Reserve, the U.S. Treasury Department, the SEC, and the Bank for International Settlements. Linda is also a visiting scholar at Georgetown Law, a senior lecturing fellow at Duke Law School, and a Bank for International Settlements research fellow. Her deep expertise in financial systems and her advocacy for data transparency and decentralized technology make her a pivotal figure in shaping the future of finance. In this episode, Linda and I share our key takeaways from the latest Stablecoin report from Castle Island Ventures, titled Stablecoins, the Emerging Market Story. Linda and I unpack what's driving today's market usage of the $160 billion worth of stablecoins, or crypto assets whose value is pegged to a fiat currency like the US dollar. Just to give you a little hint, these are not just your trader stablecoins anymore. So let's dive right in to Stablecoins, the Emerging Market Story. All right here on Money Never Sleeps. So, Linda Jeng, listen, I think we figured out the last time that we talked that we're kind of in reverse mode situations here with our lives between your Irish husband and the two of you live in the USA, and I have an Irish wife, and being from the US, but living in Dublin. Is that about right?
That definitely sounds about right. Although I've been back to Ireland 3 times already this year, including for Blockchain Ireland.
All right. Well, I've only been back to the U.S. once, and that was for the Techstars New York Demo Day back in. No, actually twice. Sorry, I forgot. I did a quick trip over for my dad's birthday in August. He just turned 80, so we did a little surprise. Hello, went up to him on the back deck and tapped him on the shoulder. Hey, Dad, happy birthday!
What a nice surprise!
Yeah, that was fun. So, listen, it's great to have you on the show. Thanks for coming on board. Really appreciate this. I know we want to talk about the Castle Island Ventures Stablecoin report, and we'll do that in a few minutes. But just to kind of give the listeners some insight as to where you're coming from, it'd be great to hear a bit about your background and what's got you to this point, yeah?
Yeah, well, Pete, thanks so much for inviting me onto your show. It's exciting to talk about my friend and actually former co-author's latest report. Nick and I had written a couple of papers together. Just by way of introduction, I actually began my career as a financial regulator. So I worked at the SEC, OCC, and also at the Fed. From the Fed, I also spent time at the Central Bank for central banks, called the Bank for International Settlements, which is based in Basel, Switzerland. So I have quite a bit of that central banking background, as well as time spent on the legislative side at the U.S. Senate during the passage of Dodd-Frank, and also at the U.S. Treasury Department, helping with the G20 global regulatory reform work that we were doing after the global financial crisis. So all of this before I decided to teach and write a book on open banking at Georgetown Law. And that was when a DeFi startup approached me, and I worked on a tokenized dollar product with them. And then from there, I went to work on the stablecoin USDC at the Central Consortium, which was a joint venture of Circle and Coinbase. From there, I went on to become the Chief Global Regulatory Officer and General Counsel of the Crypto Council for Innovation, which is a leading crypto trade association. And then about 10 months ago, I launched my own advisory firm where I work with startup founders and tech companies trying to figure out this fast-moving regulatory landscape.
Fantastic. That's great. And Sean Lee from the Crypto Council for Innovation. Do you know Sean well?
Sean, yes, a dear friend and just saw him last month. We were in Taiwan together. So he is doing fantastic work over in that quarter of the world.
Yeah, he is. He is. He's a Techstars mentor as well, and he's a pal, and he and I have done a couple of podcasts together. So shout out to Sean Lee. And also, we can't forget Mai Santa Maria, who brought us together. She's been on the show a few times. She's a good friend. So shout out to Mai as well.
Yes, absolutely.
All right. Well, listen, you mentioned Nick Carter, Castle Island Ventures, and a little humbling story is that when Castle Island Ventures started, and Castle Island Ventures are the author of Stablecoins, the emerging market story. They wrote this together with Brevan Howard Digital. And that when Castle Island Ventures started, and I saw that, and I looked at the website, and I saw the actual map of Castle Island in South Boston, where I used to live, I got so excited. I sent them a cold email to info@castleislandventures.vc or castleisland.vc. And I said, guys, this is meant to be. I would love to work with you guys someday, figure out a way to just collaborate. Nothing back. And I'm sure they got like 150 emails like that, if not 150,000 emails like that. But since then, I have connected with Matt Walsh, and he and I had a good chat and kind of, just figured out what we were both up to. So
that's a great story. My story is not as funny, but Nick Carter and I have written a paper on DeFi protocol risks, as well as the DeFi benefits and possibilities that stem out of open banking and data sharing. And that was in the book that I mentioned earlier called Open Banking. So I reached out to Nick as well to tell him, hey, I want to be on a podcast with Pete Townsend to discuss your latest report. So he was delighted, and I'm going to share probably some of his thoughts as well.
Awesome. No, that's great. And, I listen to their podcast On the Brink every Monday morning when I'm walking in the Dublin Hills, and it just gets my week started right. I think they publish it every Friday morning. But they are, being this Boston-based venture capital fund, and that they are focused exclusively on public blockchains. And I think that came out of back in 2017, 2018, when they launched, that there was a huge buzz for those coming out of corporate traditional financial services that around private blockchains. And as it turns out, private blockchains mostly just are kind of databases, right? That was one of the first things I noticed about Castle Island Ventures, is that they put this up front, public blockchains. That's what we're all about. And I think that stood the test of time since they got things going. Listening to them every week and hearing about their views on the world, they do this Deals of the Week segment where they cover everything that takes place over the course of the last week in terms of early stage venture deals in Web3 and in crypto. But they talk a lot about regulation. They talk a lot about policy, about SEC, about politics, and also moving crypto into the next level of maturity, not just in terms of product, but also people. Nick was talking about last week about how at Token 2049, he turned up to do his keynote speech, which was talking through his results from the paper, and he didn't have his blazer. So he had to go out in Singapore and buy a blazer because he felt like, you know what, we just need to bring this all up a level. And, flip-flops and T-shirts and shorts, fine. But, let's see what we can do to bring it all up a level. So good outcome.
Right. Yeah. No, we have a fashion sense too.
We absolutely do. So when I heard that they were putting out this new publication on stablecoins in emerging markets, I got very interested and excited. I listened to another podcast that shall remain nameless in the recent weeks, where the co-hosts were kind of struggling through with an expert on stablecoins on justifying their existence, coming from the angle of two folks who live in the US and who have always lived in the US and have never seen how people live their financial lives outside of the United States. And I think that when I heard about that Castle Island Ventures was publishing this, I was very eager to get it and dig into it, and definitely have dug in. So pleasure to have you here to unpack this with me, Linda. So I suggest we dive in. Yeah.
All right. Yeah. Let the fun begin.
Okay. So first, for my mom and dad who listen to this podcast every now and again, that they said, Pete, it would be great for some of these technical concepts, and I don't think stablecoins are that technical, but it'd be great if you could just give us a quick primer on how some of these things work. So when you have these conversations with interesting people like Linda, that they're able to get an appreciation of the subject matter. So Castle Island Ventures in the report, they defined stablecoins as tokenized representations of fiat currencies circulating on blockchains. And I'll just leave it at that. These were originally used by crypto traders, and now they're an asset used more widely around the world today for cross-border payments, payroll, trade settlement, and remittances. And that's a quote right from the report. But what the most interesting thing is, in the context of this Stablecoins, the emerging market story paper, is that we're seeing in emerging markets, and again, a quote right from the paper, they're being used for payments, currency substitution, to flee volatile or depreciating local currencies, and access to high quality forms of yield. People are using them who don't want to rely on a bank account that may be unreliable or inaccessible. Okay, and that's kind of the synopsis here of what the paper is looking at. It's saying, here are stablecoins, here's a history of it, here's how they work in very high level terms. But then here's how they're being used in emerging markets. And one of the big pushbacks that we all typically get around stablecoins is from people who have always just lived in the US and don't see how things happen outside the US, is that why would I need that when I got Venmo, right? And so I think this paper starts to pick apart that whole idea and to demonstrate that, listen, this is a very useful asset to use in the rest of the world. Any initial high-level thoughts on that, Linda?
Oh, gosh, so much to unpack there. As someone who had the privilege of growing up in the US, similarly never had to experience being financially excluded, to live as someone who is financially excluded in other countries is definitely going to be foreign to me. But even when I moved back to the US from Switzerland, I remember paying over 2,000 Swiss francs just to move my savings from Switzerland back to the US. And on top of that, I didn't even get a cut of the spread that the correspondent bank made on moving my savings to the US. So I certainly felt that there could be huge improvements in cross-border payments just from that personal experience alone. But we all know cross-border payments in particular is highly opaque and very expensive. And this is probably a use case that is going to be of the highest value for stablecoins. But the main point, in my opinion, for stablecoins is that it is really a payment mechanism to move value. This is why this report is so interesting, because it is the first time someone has surveyed crypto users in emerging market economies. And, kudos to them for, serving what was it, over 2,000 crypto users, and to get behind, why are you using this? What might be more interesting is, why are they using it, and what does that say about the political economy and the monetary policies of the countries that they reside in?
Yep, absolutely. People using stablecoins, individuals and businesses and traders using stablecoins, don't buy it expecting yield. They buy it because, like you said, it's instantly the liquidity that you get from that, the transferability of that are all critically important. And those are also critically important things to how people move money in emerging markets, how people move money around the world. So on the survey itself, they reached out and were able to get responses from 500 adults in each of Brazil, Turkey, Nigeria, India, and Indonesia. Those countries on average rank 6th in the Chainalysis Global Crypto Adoption Index. Okay, so Chainalysis, big blockchain analytics firm, do an annual survey looking at blockchain usage around the world, looking at crypto usage around the world. And so a total of 2,541, like you said, of adults in total. And that some of the key high-level takeaways, it's now, after doing the survey, and this is a quote from the report, it is abundantly clear that stablecoins have evolved from mere trading collateral to a general-purpose digital dollar instrument in the countries surveyed. Okay? But looking at the first thing that I really took away from this down into the detail of the report is that stablecoins account for approximately 50% of all value settled on public blockchains. And it's reached as much as 70% in the past, and it's all overwhelmingly USD. So stablecoins pegged to the US dollar. The general public doesn't know about this stuff. I think, that half of what we've built here in crypto is moving US dollar around the world in seconds. We are not evil, okay? And most don't know about this. Even Charlie Munger, may he rest in peace, he did a podcast episode with John Collison on Invest Like the Best, and where John started talking to him about crypto and said, listen, I know we have our differences. John tried to go down the stablecoin path, and Charlie clearly hadn't heard about that yet. Okay, so you talk to people that are not in this space, they generally know what Bitcoin is, but they generally don't know that stablecoins exist and that these things are such a huge component of crypto volumes around the world. I had been talking about 73% in centralized crypto exchanges, but the 50% overall on public blockchains was a big eye opener for me. That was great to get an understanding of.
Mm-hmm. And isn't it interesting that stablecoin usage has continued to steadily increase even during crypto winter?
Yeah.
There are real non-crypto use cases here for stablecoins.
Yeah, there absolutely are. And that, looking back to 2017, 2018, when they first started to come into existence, like I was hanging around London a lot at that time with a group called 11FS. And people were using the term tether coins. And it didn't have to do with Tether, USDT. It was just what people were talking, how they were referring to them at the time. And I remember Simon Taylor, shout out to Simon, he said, just stop calling them that. They're not tether coins. And interesting that, the stablecoin term came out of that era and we're still using it, but that they really are digital dollars is what they are, that are not issued by a central bank. Lots of dollars being moved around the world on crypto rails. And that was the first big thing for me.
Yeah. And you bring up the elephant in the room, which is how come CBDCs are not as popular? There have only been a few that have been introduced so far, but even the ones that have been introduced are not used to the same extent as stablecoins. So you take Nigeria, for example, which is one of the countries that was surveyed, and Nigeria has a huge rate of stablecoin usage, despite it having a CBDC called the e-Naira. And so I find that quite interesting. Like, how come they're not using the e-Naira instead of stablecoins? Well, obviously, it's because the Naira loses value, whereas the US dollar is still the US dollar. And so they view these stablecoins as digital dollars, as you described it, Pete. And that is the real strength behind these stablecoins. So what does this mean for the Nigerian Central Bank? And also what does this mean for the ability for emerging market economies to plan their economies? It means this is actually a major threat if you think about it. As a central bank, if you are only able to exert monetary policy influence through your currency, and if no one's holding the Naira, then how are you going to be able to implement and pull any policy levers? So I think that's a big problem there. And then on top of that, if fewer and fewer people are holding a local currency, the local currency loses even more value. And certainly it would lose seigniorage. And so this is a problem that I think many emerging market economies around the globe are going to have to face, whether or not the Fed issues a digital dollar or not. We already have privately issued U.S. dollar-denominated stablecoins.
Yep. And looking at Nigeria specifically, and that's a great point about will that country be able to manage its own monetary policy through its own currency if there is so much commerce in that economy that is taking place with the US dollar, with stablecoins. And that my friend Ali Walsh, who's the founder and CEO of a company called Pipit Global, and they are have a long history over the last 7-8 years of being on the ground in Nigeria. And the word on the street is that there are two exchange rates in Nigeria. There's the one that you can get from the banks for naira to dollar, and then there's what you get on the street. And the street exchange rate is much better, and it's almost 30 to 40% better because of just people are more willing cash in hand, So perhaps that speaks to the lack of popularity of the e-naira because you are exchanging probably at a bank rate in order to get the e-naira. Or if you're trying to get e-naira back into US dollar, you're not getting as good of a rate as you would in the street in hard, cold cash, right? So lots of threads to potentially pull on there, but stablecoins are digital currencies, and there are digital currencies that have crept up in the world, but not very popular yet. And we'll see how that story unfolds over time. Yeah.
Yeah. And that's why, the Bank for International Settlements is really concerned about stablecoins and really pushing for the development of CBDCs and, why they've set up BIS innovation hubs around the globe. And most recently, the general manager, Augustin Carstens, had put out a white paper for this new concept called the Finternet. I don't know, Pete, have you heard about the Finternet?
No, I haven't.
So the Finternet is an idea that Carstens has about building a unified ledger for all the central banks around the world to use. And it would be tied to a digital identity layer. So these are essentially the two layers that are currently missing in the internet today. And they see that central banks are losing power, losing authority. But if they're able to build the monetary layer and the identity layer and have it be controlled by the central banks, then this could be a way for them to maintain control of the global monetary system. So so check out the white paper. It's on the BIS website. I have a lot of my own opinions about it.
Okay.
But this is the central banking world's reaction to this U.S. dollarized stablecoins as well as U.S. dollarized public blockchains.
I gotcha. Yeah, I will check that out. And I will also stick it into the show notes so that people can check it out as well, the Finternet. And you tweaked my interest there when you said digital identity, obviously, and digital money. And that's where there's so many opportunities that are opening up here, both from an early stage startup perspective to get this right, but also from a let's be careful perspective at the top of the stack, because there's a lot at stake.
If I can build on that, what is interesting on the digital identity component of the white paper is that Carstens teamed up with the technologist who developed the Aadhaar identity program in India. Aadhaar, super impressive program that the Indian government put out. They were able to get biometric issued identity to over 90% of the Indian population in a matter of a couple of years.
Yeah.
And that's also significantly reduced the number of unbanked population in India. So I think it went from 60% unbanked down to only maybe 20% unbanked in a matter of a couple of years.
Wow.
And so Aadhaar was considered a huge success. But what is very interesting about Aadhaar is that one is biometric based, so it requires fingerprints and iris. And then two, it's centrally managed. So that raises some questions about the design. So far, at least I've been told that the central core has not been hacked, but I keep wondering, will it be hacked one day? And then what would happen if it were hacked? I can only grow one iris. I can't regrow another one. And so once that data is out, then what? So having partnered with the technologists who created Aadhaar to help design this digital identity layer component of this internet, it does mean a reliance on centrally issued digital identity, which I think with existing technologies today, I don't think we really have to do that so much anymore. I think we can actually start thinking about, hey, are there ways that we can be able to bring control of our personal data back to us? the
Yes.
users.
Yes, absolutely. And my Santa Maria and I had a chat about this a few months back on getting very excited about the digital identity project in Europe and then realizing that it's centralized and it has nothing to do with blockchain. And then we looked out across the world and we saw projects in Argentina and Brazil and Mexico that were blockchain based and that were, okay, now these countries are perhaps getting it right. And that, yes, that when it is centralized, will it be hacked? Like you said, you can't regrow your iris unless you're Tom Cruise in Minority Report. No, he got it from somebody else, didn't he? He took it from somebody else. He
I don't
bought
remember.
the irises on the open market, bought the eyeballs. Yeah, we don't want to go that far, do we, Linda? I like my eyeballs. I don't need any more. But this is where some of the, around stablecoins, the rhetoric around it is that, listen, we are re-centralizing crypto. And it's like, well, with stablecoins being something that in order to back the asset with real world assets, that you need this component of centralization in it. Now, the use is decentralized and the ability to trade peer-to-peer makes it decentralized. So we've got some striking polarity going on here. But on the stats, and I wanted to get to this, when Castle Island Ventures looked at stablecoin usage, they saw the adjusted volumes of $3.7 trillion worth of transactions in 2023. And what they did is that, I'm not going to get into the how and the why, but on the stablecoin volumes, there can be a lot of double counting when it comes to the different types of trading that takes place in the crypto markets. So they looked at all of that activity and they peeled back the types of transactions that may be viewed as double counting, and they landed on 3.7 trillion. That volume is pretty good. That's about half the volume of what's on Visa or MasterCard on any given year. So this year, 2.62 trillion so far in the first half of 2024, projected to hit 5.28 trillion US dollar in volumes by the end of the year. That's serious volumes that are moving on public blockchains here in terms of USD. To your point on the most interesting takeaway from all this is how stablecoins are being used in emerging markets. And like I said at the beginning, these stats are going to be perplexing to the average US citizen that's using Venmo and that had never been outside the United States or using perhaps a US fintech banking app and thinking, why would you ever need anything else? And that, access to crypto is still the most popular use case for stablecoins in these 5 countries, in these 5 emerging markets. But just behind that, 47% said that one of their major goals of using stablecoins was saving money in dollars. That makes sense to me. If I were living were relocated to India, Indonesia, Nigeria, I'd be saving money in US dollars still. I wouldn't be saving money in the local currency, but that's just me. This is people on the ground that have lived there their whole lives decided I'm going to save in US dollar. 43% mentioned better currency conversion rates. We've talked about that already. And 39% said earning a yield. You can actually put stablecoins to work to earn a yield. They now have yield-bearing stablecoins. You can also use stablecoins in decentralized finance protocols in order to earn. Okay, so those were the top 3 were saving money in dollars, getting better currency conversion rates, and earning a yield. Do those things resonate with your views and where you think things had been heading?
That is such a staggering number, 5.28. The fact that is how much stablecoin volumes will be by the end of this year, this just shows that stablecoins are here and they're here to stay. And they have real use cases that are not crypto. And saving dollars, it makes a lot of sense. I mean, I have family still in Taiwan. And even though Taiwan's a wealthy country, they still like to save in dollars because you never know what might happen in the future. There are lots of geopolitical issues in that region. So you have geopolitical fragility, and then you also have economic fragility, monetary fragility, and instability. Many countries, including ones like Argentina, where the value of the peso is different at the end of your meal than at the beginning of your meal, when you're having dinner, right? And so the stability of the US dollar suddenly, is highly valued. And that has always been why it's so important that we work hard to maintain the US dollar as a global reserve currency.
Looking at where the stablecoin use started and started with traders needing that in crypto, either to park their assets overnight, so that when you stop trading for the day, you got to go to bed. You want to lock down, bringing it to that business level, that enterprise level. 85%, I think is the number. 85% of global commerce takes place and is denominated in US dollar. So it just makes sense that we've got these digital dollars, stable coins, that are moving the direction of gathering tons and tons of volume as well. Some of the other usages of stable coins in the emerging market countries that the report surveyed, that 37% said that the reason they use stable coins is that they wanted to convert their local currency to US dollars for one reason or another. Obviously, there are those that are saving, but there are those that just need to convert for one reason or another. Other 34%, and this is where it got kind of into some of the crypto ethos, or not crypto ethos, decentralized ethos, was 34% said they wanted to take their finances into their own hands. And that jumped out at me alongside the next one of 29% saying that they wanted to have self-custody of their money. These folks are living in an environment where the banks aren't as reliable or accessible as they are in the US. And that is a very real day-to-day worry that people have that generally is that we don't have in the US, right? That makes a big difference, doesn't it?
So there is bank deposit insurance in many countries.
Mm-hmm.
And you can take a look at the EADI website to see, who the members are. So you would think that should be comforting. However, none of them has had the history in the record that the FDIC has had in terms of coming in and covering the bank deposits up to a certain threshold. And so it has had a proven track record of being able to go in and resolve banks and paying out the bank deposits to a certain amount, right? But I have not studied how bank deposit insurers work in other countries, but it requires also political willpower, right, to ensure that, yes, your deposits are truly safe. And if they're not safe, the government will step in and help make you at least partially whole. So there are probably lots of issues at play, depending on the country and depending on the country's financial system. But even if a country has a good financial system, its currency is still not the global reserve currency. And so the US dollar, it will always be the de facto preferred denomination. And there are other countries that feel like this is not a fair situation. And you see China building out payment rails in the global south and working with big exporters to allow them to settle in their local currency. So I know that most recently Brazil and China agreed to a trade agreement where Brazil can now settle in its local currency. And OPEC has also recently agreed to allow payment in non-US dollar denominated currencies. And so all of this is interesting when you look at blockchains. Public blockchains, though, is still 99% US dollar denominated.
Yeah, it is. And I think it's that context of international commerce. Like a company that I almost invested in back in March, that their whole business existed. And this was on the east coast of Africa because they had SME clients that needed to get access to dollars. They're having a very hard time doing that through the banks. And so they set up a whole utility to be able to do this via stablecoins. And that so that they could settle their international importer-exporter agreements and payables and receivables with countries and business partners outside of Africa. And that it was all done through US dollars. And that we have this grassroots use case for US dollars. It's coming up through the consumer level. And it's going to be interesting to see where that meets and to see where that may then drive other currencies to start to get more volume. I think Circle have the Euroc, right? Let's
Yes.
rock Europe. But that we've got, that is still, I think, less than 1% of the volume of stablecoins, right?
Yeah, I think it's like zero, even less than half of 1%. And this is definitely a big concern for the European regulators who really want more reserves parked in the EU. And so they're going to have to do some, I think, more creative thinking to see how to make the euro or digital euro more attractive on blockchains. Going back to your point about Americans not understanding why do people use this? Because, we use Venmo and Venmo has this great user experience. But the truth is that money transfer is actually not instant. It is actually just on PayPal's internal ledger. And you yourself, the users, actually don't get the money unless you pull the money down from the Venmo account down to your bank account. And that actually costs money, and that takes also time as well, at least a minimum of 1 up to maybe even 5 business days via ACH transfer. So it's just because we are able to put so much trust in these intermediaries that maybe we don't feel the need to, use these stable coins. But if you live in a world where you cannot trust the intermediaries, or you don't trust them as much, then you will find these stable coins much more attractive. And this really brings up the point of perhaps this is the competition that these financial systems needed all along to improve and to actually meet the needs and desires of their local citizens.
Totally. Yeah, I'm with you on that. And it's really interesting. You got me thinking now about when you look at the US dollar dominance in stablecoins, why is euro not bigger? It's for the same reason that Venmo is huge, or that Venmo is just the default in the US, is that it's there, it's easy. People living in that economy only need to transact in US dollars. There's far simpler ways to do that with better UX than a stablecoin right now. Stablecoins will eventually move up the UX curve, and we'll get there, but I still don't think they'd be used to a huge extent in the US for everyday commerce and everyday transactions. Maybe at some point, but there's no need for them right now. In Europe, people that are living in Europe and their financial lives are denominated in euro, that they're doing the same thing. We're revoluting euro all over the place, okay? And that's one of the fintech banks on this side of the pond. And that there are the whole SEPA system in Europe means that you've got a lot of instant settlements that take place. We're using things like Wise or TransferWise, the old name. And so it's all easy to use. It's right there. Euro, however, is not used pretty much outside of Europe. When you go to different countries around the world, would you find a local market of people with euro in their pocket that are doing some local exchange rate on the streets different to the bank rate? Absolutely not. Because it's a US dollar that is sought after in so many different countries around the world as a stable currency. And so the use case for dollars has evolved through stable coins in these emerging markets because of that context. And it's that very same context that will mean the development of other currency stable coins, where those hard currencies like euro, like pounds, like Swiss francs, are not used anywhere on the streets outside of their own domestic economies. I think that's a really interesting takeaway that really has me thinking now, Linda.
Yeah. And, we can't forget history. When the Bretton Woods Treaty was signed at the end of World War II, the British had wanted an altogether new currency called Bancor. So this was an idea by John Maynard Keynes. And Bancor was going to be backed by a basket of lots of different currencies, kind of similar to what the IMF has now with its SPDR, which also is not very well used. But that's a different discussion. When John Maynard Keynes put forward that idea of Bancor, that would be backed by a basket of lots of different currencies, the U.S. had held to know. Why would we agree to that? We were the ones to help you win the war. We are now the global economic superpower. the global reserve currency should be a mix of gold and the US dollar. And that's how the US got its, foot in the door. And then over time, we depegged from gold. And so now it's just US dollar, and payment rails were really built around the US dollar. And now we see more payment rails, but now over, public blockchains, which I really view as public digital infrastructure, and that are also built around the US dollar. And so it is an irony that crypto gets so much political flack here in the US when it's actually blockchain that is one of the biggest proselytizers for the US dollar.
Absolutely. No, and that was one of my big takeaways as well, is that the very nature of stablecoins means that when individuals in emerging markets use dollar-linked stablecoins, they are indirectly purchasing U.S. debt instruments, such as short-term treasuries. And this is, again, a quote from the paper and what they refer to as crypto dollarization. Stablecoins are the 16th or 17th ranked buyer of U.S. sovereign debt around the world.
Wow.
That's a big number. And this is a number that Nick and Matt from Castle Island Ventures have referred to quite a bit on their podcast, On the Brink. So, and it gets stuck in my head. I think it's either 16th or 17th largest buyer of treasuries or holder of treasuries amongst sovereign nations. It's, I think, even bigger than the Netherlands, perhaps, around the world, which is quite big. I'll leave it at that.
Yes, very big. And then, and then it's not surprising that Fed Chair Jerome Powell testified last year that he views stablecoins as a form of money. And that was a pretty big statement on his part.
Mm-hmm. Absolutely. A couple of the other things that I took away from this that I thought were quite interesting was just how much Binance have integrated into all of this, and that Binance is used all over the world for access to crypto, but also now access to stablecoins, and that quite a big chunk of the respondents' access into stablecoins was coming through either the Binance app or the Trust Wallet, which was primarily the wallet used on Binance Smart Chain.
Mm-hmm. Yes, and what was also very interesting was that Tether is also very dominant.
Totally.
And we all know Tether is rather opaque. We're not really even sure what is backing Tether. And for all we know, it could be short-term commercial paper in China.
Yeah.
And yet people still use it, even though there are lots of regulatory issues around Tether.
Yeah. Reading some of the quotes in the paper of people saying, listen, it's what my friends use. There's a network effect to it. I will use the stable coin that I think is going to have the most liquidity, and that where I don't actually have to go get another stable coin in order to complete a transaction. So I think it was first to market. It's the largest. It has the most liquidity in it. Is it opaque? Yes, absolutely. But it's the brand that tends to come first when people are looking at doing transactions in stable coins. So I thought that was interesting as well. Is it just that dominant still of Tether in the market? And I wonder how long that will last and what some of the catalysts may be to more of an equal weighting. So that was another one. Any interesting kind of final points that you may have on this, Linda, that you wanted to make sure that you shared?
Well, I think there's a lot of discussion around what will the role of stablecoins be once CBDCs come out. And I feel like the discussion is a bit of a red herring, because I think people forget that we already live in a multi-money universe. Even here in the U.S., we not only have, hard paper bills, which are, direct liabilities on the Fed balance sheet, but the truth is 95% of the money supply is actually money that's issued by commercial banks. And commercial bank money, to me, and stable coins issued by private issuers, to me, they're actually can be part of the same money supply. and form the M1 layer on top of that M0 layer of paper money. And so I can easily see a hybrid world where, stablecoins just becomes another form of money, and we need to then therefore design our monetary system around it.
Absolutely. No, I'm right there with you. I think these two will cohabitate. I mean, over the years, my mindset towards CBDC shifted when the surveillability, if that's the word, entered the conversation and, got me thinking about things. But I think they will eventually happen, and that I don't think stablecoins are going anywhere because it's still a good idea. I think it's still an excellent idea, even with CBDCs. So I think there's probably another conversation in the works for us down the road, Linda, that would be on any number of these topics that we've brought up today. But I think my biggest takeaway was talking to you today and getting that point straight in my head about why non-USD stablecoins have not yet broken out of the tiny, tiny existence that they're in today. And that was a really valuable part of this conversation. So thank you.
Oh, you're welcome. And thank you for inviting me. This was fun.
Awesome. And looking forward to talking to you again soon. So we got a bit technical in this episode, folks, and I just wanted to round things out and recap before we closed it out. So we talked about 4 key takeaways from Stablecoins, the emerging market story from Castle Island Ventures. As we talked about, it's their latest stablecoin report, and obviously we'll link this in the show notes for everybody. First takeaway, 1, stablecoins are the killer app of crypto so far, with stablecoins accounting for 50% of all value settled on public blockchains. The second key takeaway, stablecoin volumes continued to grow during crypto bear markets as stablecoins crossed the chasm into more mainstream fintech, with real usage volumes of $3.7 trillion in 2023 and projected to reach over $5 trillion in real usage volumes in 2024. $3 to $5 trillion level is even more interesting when compared to something as common as a faster payment scheme in the UK, which does about $3 trillion in annual transaction volume. The third key takeaway, the feedback gathered with the survey pointed to a number of day-to-day use cases solving everyday problems for consumers and SMEs in emerging markets that are not problems for U.S. consumers, which explains why the average U.S. consumer or small business owner just does not get the point of stablecoins, if they're even aware that stablecoins exist. And the fourth key takeaway, as we talked about, the ubiquity of the US dollar for use in global commerce and as a stable store of value around the world makes it unique compared to other big currencies like euro, sterling, the Swiss franc, and yen. While consumers and businesses outside the US would have a need for the US dollar, with or without stablecoins, they have far less of a need for liquidity in the other big currencies. This is one of the reasons why US dollar stablecoins dominate the stablecoin landscape, because many of the problems that US dollar stablecoins solve, things like fast and cheap cross-border remittance, more stable savings in your domestic currency, better currency conversion rates in your domestic currency, these things aren't generally solved with non-dollar currencies today. People are using USD. So even though non-dollar stablecoins are available, dollar stablecoin users, both individuals and businesses, and those who might become stablecoin users, don't really have an addressable problem that non-dollar stablecoins solve better than dollar stablecoins yet. So the story will continue. That does it for this week, folks, and you can learn more about everything we covered with links to resources in the show notes on our website, moneyneversleeps.ie. Thanks to Linda Jeng for all of the insights she shared in co-hosting this episode with me. And of course, a special thanks to the team at Castle Island Ventures for publishing such a great report. It's a very enjoyable read, so thank you, and go Red Sox. Next year, if you like what you heard, please leave us a rating and a review on Apple Podcasts or Spotify as it helps others to find the show. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early-stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. Applications are open now for our spring 2025 class, so check us out on techstars.com/accelerators/web3 to apply. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!